Good morning, good afternoon, good evening. My promise to you is that by the end of this video, you will have more clarity about the concept called inducement. But first, let me ask you this question. What do you think is the number one motivation of banks that are involved in the foreign exchange market? Well, the answer is money. The institutions have two objectives: to engineer liquidity and to take it out. These two objectives share one purpose, and that one purpose is to make money. Inducement happens as a result of this one purpose, to make money. By the way, if you want to accelerate your trading progress and save yourself time, then click the link in my description section below and join the community of traders that are on the way to becoming Forex masters. Inducement is a swing high or a swing low that is positioned right before Asia session. These swings are traps that entice impatient traders to place their orders early. These orders inevitably get stocked out by the price. The accumulation of orders generates higher profits for the liquidity providers. Inducements are areas in the market that are placed right before a supply or a demand zone. They're also placed in particular sections before order blocks. Example number 1. First of all, we have our Asia session box right here in gray. Then we have consolidation where the price went sideways for a couple of hours. The low of Asia is marked out by this line over here. Underneath it, we have an official swing low. This swing low happened right before Asia session. So as you can see, here's that swing low over here. We draw it out into the future, and when the price stop hunted the Asia low, it also went past this inducement level into our 30-minute unmitigated order block. Straight after that happened, what did we get? So we first targeted this low. That's our Asia session low right here. And the first move, as you can see, price ranged for a bit. The first move was into this level over here. That's our stop hunt. That is our liquidity grab. Straight after that happened, we got a strong rejection and the price moved to the upside. That is the power of identifying inducement levels, liquidity lows, liquidity highs into unmitigated order blocks. Example number 2. Here we have Asia session box right over here in gray. This level right here is the Asia high liquidity. The price stop hunts Asia lows, Asia highs, daily lows, daily highs. Each swing has liquidity placed in that level. So now we have an official swing high right before Asia session closed right here. This is our inducement level. This is our inducement level. Right here we'll draw it out into the future, and around top of Asia right here we have our unmitigated order block. We'll draw it out into the future. What did the price do? The price stop hunted the Asia high, went past the inducement level into our bearish order block on a 1H time frame. And this is our move to the downside. Once again, this is the importance of knowing how to identify your levels within your charts. Next example. Example number 3. I have a term that I use called the first principle. The first move principle is that usually the first move out of Asia, if it stop hunts the Asia low and it goes past the inducement level, then it's usually going to be a fake out. This move right here is a fake out. That's a fake move, so pay attention. So we grab liquidity from the Asia low. This level right here is our inducement level, which actually coincided with our order block. And as soon as the price reached it, we had a strong rejection and the price moved to the upside. First take profit is the previous day high. Example number 4. We have another very easy example. Remember this: simplicity scales, complexity fails. Remember that. So we have our Asia session right over here. Right on top of the Asia session, we have our Asia high liquidity. This level right here is an official swing high. So therefore, that is going to be our inducement level. And right on top of it, we have a 30-minute unmitigated order block. And pay attention, what did the price do? The price moved to the upside, stop hunted the Asia session high, went past the inducement levels by enticing people to place their orders early. We even had an early rejection here. If you go to a smaller time frame, you will see that there were probably 5M engulfings right here. The price pushed higher into our unmitigated bearish order block, and then we had our move to the downside. Example number 5. So in this example, we can clearly see that the price is bullish. Okay, the price is bullish. What do we identify first? We identify our Asia session box. This is it. Step number 1 complete. That's the in gray. So then we identify our Asia session low. This is it. Then we identify our inducement level. Our inducement level is this swing low over here. That's our swing low. And then once the price actually goes past the Asia lower liquidity, past the inducement level, it finally got into this order block right here. 30-minute order block. We had a strong rejection and then a move to the upside. Easy. Keeping it simple, nothing complicated. If you want to further expand your understanding of how the banks trade, then you need to click on the video on your screens right now. Thanks for watching. I'll see you guys in the next one. Take care.